We've been talking China all day long, all morning long. I mean, this is yet another piece of news that's negative for the outlook for its assets.
Yeah, pretty much. I mean, at this current juncture, you've got both the property sector in turmoil, and then you've got, the trust sector in slight turmoil as well. Slight probably is understating it slightly. And, for us, when you've got both of the events really sort of dampening further home buyers' confidence in the market, and also the sort of, wealth effects on a lot of these investors in these trust funds, it's undoubtedly that we've got to push our outlook lower, our growth outlook lower. And so undeniably, we're looking at further depreciation in the CNY, but it could bode slightly well for bonds, front-end bonds especially. We've got a bull steepener there. But yeah, they will have to put more fiscal policy at work.
Let's pick up on the yuan. You talk about further weakness. How much weakness? I mean, what's fair value for the currency right now, given all the negativity that we're getting?
It's hard to tell where fair value is, given, you sort of think about the medium-term outlook for China's growth, right? We're looking at anything between 3.5% to 4.5% growth for China over the next 2 to 3 years as it transitions this growth drivers. So it's going to be a struggle. So fair value is still undetermined at this point. But, by and large, everyone likes China growing at 6%. The fact that we're starting to talk about 3.5% growth tells you exactly the direction of travel it's going to go.
Right, and the fact that we are at subpar growth is, to your other point earlier, it's good for bonds. If you could clarify, because you mentioned bull steepening, were you describing the move, or do you expect the curve in China to bull steepen for it? In other words, would you lean into the CGB rally?
I'd lean into the CGB rally, especially in the front end. The back end, the steepener is really more from the fact that the front end is we're seeing a few more easing coming through from repo rates and MLF and LPR ratios. But on the back end of the curve, because the truth of the matter is every 10 basis point cut at this juncture where there's really no demand for credit really doesn't do very much for the economy. So fiscal needs to come in, and that's what's going to lead to the next side, the steepening of the curve, that is, when issuances come through.
Okay, then I guess at that point we'll just have to talk about that when that happens, because we've been waiting for it and it hasn't come. That takes me into, I guess, an ex-China conversation, if that's okay. Because inflation is not a problem in China, it's still a problem in other parts of the region. Are we underplaying the risk of inflation coming back, is my question.
We are. We look at EM on a whole, and a lot of ex-Asia EM countries at the moment have priced in a lot of rate cuts, and we still have El Nino as a risk. So for us at this point, sort of transitioning some of our initial allocation into those markets out of that region, or out of LATAM really, or South Africa, into Asia is actually quite good. We are probably underpricing El Nino risk somewhat, but by and large, a lot of Asian countries haven't priced in any rate cut expectations. And a few countries here, like India and Indonesia, has had a relatively good track record over the last round of El Nino that showcases how government can use things like import-export tariffs moves, etc., food storages to help dampen that risk slightly. So for us, this is probably somewhat safer relative to other regions at the moment.